Everyone's whispering again. Banks are in trouble. Deposits are falling. Liquidity is drying up. We've heard this story before, and sometimes it ends with headlines, sometimes with panic. So what's happening this time? Is there really another banking crisis forming under the surface, or is this just another wave of fear echoing through the system? Let's take a breath and look at the facts, not the noise. Because the word crisis in finance doesn't appear out of nowhere. It starts as a whisper, turns into a trend, and finally explodes into confidence loss. We're somewhere in between whisper and trend right now. And that's exactly the point where truth and rumor are hardest to separate. So here's what's actually going on. Over the past few weeks, several U.S. regional banks have reported losses on their commercial real estate loans, especially offices and small business properties. Remote work, higher interest rates, and declining property values are all squeezing that sector. For some mid-sized banks, that's a serious problem because commercial lending is their core business. When those loans go bad, balance sheets start to wobble. At the same time, something deeper is happening: liquidity migration. Big depositors, corporations, funds, high net worth clients are quietly moving money from small banks into money market funds and treasury ETFs. Why? Because they can earn 5% safely, backed by the U.S. government, instead of leaving money idle in a regional bank at 0.5%. It's not panic, it's math. But when enough people make that decision, it feels like panic. This is how modern crises start. Not with lines at the ATM, but with silent capital flight. Now let's be clear. The U.S. banking system is not collapsing. The big banks, J.P. Morgan, Citi, Bank of America, just passed the Federal Reserve's stress tests. They have strong liquidity coverage ratios and access to the Fed's Bank Term Funding Program, which allows them to swap underwater bonds for cash. In simple terms, the system can still breathe. But beneath that surface, fractures exist. Regional banks still hold hundreds of billions in long-term bonds purchased when interest rates were near zero. Those bonds are now worth much less. If these banks had to sell them to raise cash, they'd take massive losses. Exactly what triggered Silicon Valley Bank's collapse in 2023. So even if they're not selling yet, the pressure is there. It's like holding a balloon that's a little too full. One bad week of withdrawals and it bursts. So is this a crisis? Not yet. But it's a slow-motion replay of the same dynamics that broke confidence before. Let's understand why this keeps happening. The entire post-COVID economy was built on free money, zero interest rates, quantitative easing, and massive stimulus. That money flooded into everything: tech, real estate, crypto, and yes, banks. When the Fed reversed course, raising rates from near zero to over 5%, the math of the system flipped. Suddenly, all those long-term assets were mispriced. Bonds fell, deposits shrank, and the illusion of stability cracked. The system wasn't ready for a world where cash had value again, and now we're living through the adjustment. Think of liquidity like water. It always flows toward higher ground. In 2020, that meant risk assets. In 2024 and 2025, it means treasury bills and money market funds. So money is leaving smaller banks not because people hate them, but because liquidity is being pulled uphill by yield. And that migration makes the lower layers of the system weaker. Here's what the data shows. U.S. commercial bank deposits are still about $17 trillion, but the composition is changing fast. Money market funds now hold over $6 trillion, the highest in history. The Fed's emergency bank funding programs still carry over $100 billion in loans. None of those numbers scream meltdown, but together they whisper stress. That's why this moment feels uneasy, not catastrophic, but fragile. Confidence is steady until it isn't. And if you zoom out, there's a political layer too. We're in an election cycle. No administration wants a financial crisis in campaign season. So officials will downplay risks, issue reassuring statements, and extend liquidity facilities quietly. That doesn't mean they're lying. It means optics matter. Because in finance, belief is balance. As long as people believe deposits are safe, they are. Confidence is literally the collateral of the modern banking system. So how do we tell rumor from reality? There are 3 questions that cut through the noise. First, is liquidity shrinking or expanding? If central bank balance sheets are contracting, liquidity is being drained. That's pressure. If they're growing, it's relief. Right now, the Fed's balance sheet is roughly stable, meaning no big rescue, but no big tightening either. Second, are deposit flows stable? Look at the weekly Fed H8 report. If deposits at small banks are dropping sharply, confidence is slipping. Lately, those numbers have been volatile, but not collapsing. That means people are cautious, not terrified. Third, are funding costs rising? If banks are paying more for short-term borrowing in repo markets, that's real stress. So far, short-term spreads are calm. That's why Wall Street isn't screaming, yet. So yes, there's stress, but it's localized. It's not 2008, it's 2025, the slow version. Crises don't explode instantly anymore. They leak, they simmer, they unfold on balance sheets, not in headlines. Now, let's connect this to the crypto world, because liquidity never disappears. It just moves. When banks feel pressure, they tighten lending. That slows economic activity and pushes investors toward alternatives, like gold, Bitcoin, or stablecoins. During the 2023 banking panic, Bitcoin rallied 40% in a month. Why? Because confidence in banks fell, and crypto looked like a parallel escape valve. If fear rises again, we might see a similar pattern. Not because crypto benefits from chaos, but because it's outside the traditional collateral chain. That's the irony of modern finance. Banks need trust. Crypto needs distrust. When one weakens, the other often strengthens. But don't confuse rotation with revolution. If there were a real systemic crisis, multiple big banks failing, credit markets freezing, even crypto would feel the shock. Liquidity stress hits everything. In the short term, fear sells everything. In the long term, it rebuilds new belief systems. That's why watching liquidity is more important than watching price. So what should we, as observers, actually track right now? Here's your checklist. Simple, visual, and real. 1. Money market inflows. If they accelerate, liquidity is moving away from banks. 2. Regional bank stock indexes. If they trend lower while big banks rise, stress is concentrated. 3. Fed lending facilities. If the Bank Term Funding Program balance starts climbing again, that's an early warning. 4. Treasury yields. If yields fall sharply, it means the market expects the Fed to step in, a classic fear signal. And 5. Credit default swaps, CDS on major banks. They rise before the headlines do. If you see all 5 flashing at once, that's when whispers turn into reality. But right now, only 1 or 2 are blinking. So we're not in crisis, we're in caution. And that distinction matters, because markets often overreact to the word crisis, forgetting that systems evolve. The Fed learned from 2008 and 2023. They now have standing liquidity backstops ready before panic hits. It's not moral hazard, it's muscle memory. Still, no safety net can fix the deeper issue, trust erosion. Every time people hear regional bank losses, they withdraw a little faster next time. Every reassurance buys less time. And over years, that slow erosion shifts power from banks to markets, from deposits to digital money, from institutions to code. That's the long-term story hiding inside these short-term headlines. So, is America facing a real banking crisis right now? No, not yet. But we are watching the next chapter of a long confidence cycle, the slow redistribution of trust in a system that still runs on belief. It's not panic, it's transition, And that's what makes this moment so dangerous and so fascinating. Because when confidence becomes fragile, even small events can trigger big reactions. A rumor, a balance sheet loss, a single tweet. That's all it takes to bend the curve. That's why it's critical to separate information from amplification. Most people react to the echo, not the source. So here's the takeaway. Don't panic over the word crisis. Watch liquidity, not headlines. Follow deposits, not emotions. And remember, fear itself moves markets faster than fundamentals ever could. We're not in 2008 again. We're in something new, a slow, data-driven, algorithmic version of fragility, the kind where confidence leaks quietly instead of collapsing loudly. And in that world, awareness is your best defense. This is not financial advice. It's perspective. The whispers are real, but the collapse isn't. At least, not yet.